I said I didn't believe the Fed. I didn't believe that they weren't intending to cut rates. I think they absolutely knew that they were going to cut rates again. There's a lot of behind the scenes pressure from the Trump administration, so they're getting a cut. The Fed is really concerned about is potential weakness in the labor markets. So I think the odds of a December rate cut, which had fallen back down from like 90% to like 50%, are now back up above 80%. So that's what's going on with the markets. And I think that is also why you're going to see this surge in gold. And I think the dollar is now just rolling over. On Friday, I again encouraged everybody to go out and buy Bitcoin over the weekend. I mean, not Bitcoin, to go out and buy gold and silver over the weekend, because I thought we would have a big move up on Monday. And sure enough, we had a huge move up on Monday. And so if I don't do another one, just keep on buying. Buy over the Thanksgiving holiday, buy over the weekend.
Growing pressure on U.S. monetary policy is now spilling directly into the metals markets, where shifting rate expectations and weakening economic sentiment are driving renewed demand for hard assets. With traders increasingly pricing in another December cut and the dollar beginning to roll over, the backdrop has tilted firmly toward gold and silver strength. Surging physical buying, softening labor indicators, and a declining confidence index all reflect an environment where traditional policy tools are losing traction and inflation concerns remain embedded. Peter Schiff, a longtime macro analyst known for his focus on real money and fiscal imbalances, emphasizes that the Fed's public uncertainty is masking a predetermined path toward easier policy. His view centers on structural weakness beneath official data, rising political pressure surrounding rate decisions, and foreign developments, particularly Japan's rising yields and potential Treasury sales, that could accelerate the return of quantitative easing. Together, these forces point to continued upside for precious metals, with gold poised to break prior highs and silver poised to outperform as liquidity cycles tighten. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think that the gold and silver stocks are going to hit new highs before gold makes a new high. Maybe not silver. Silver could take out the high, which was 54.40-ish, before gold. In fact, I think silver will make a new high before gold, but gold will make a new high probably before the end of the year. And what is going to be driving gold to record highs and silver to record highs and gold and silver stocks to new highs is going to be the Fed. Remember, we have one more FOMC meeting. I believe it's scheduled for December 10th. I believe the Fed is going to cut rates again. And if you recall, the last FOMC meeting, that's when Powell threw a monkey wrench into the whole rate cut, narrative by kind of saying he didn't really know what he was going to do, that it was kind of like a coin toss, that, they could cut rates, they could leave them the same. They really didn't know. It kind of depended on the data. And that really pulled the rug out from under these expectations. And the markets went down. They were nervous about it. And if you recall what I said on my podcast, I said I didn't believe the Fed. I didn't believe that they weren't intending to cut rates. I think they absolutely knew that they were going to cut rates again. They just didn't want to come out and admit that. They wanted to pretend to the markets that it's not a sure thing, that it's not a lock, and that, they're weighing the evidence, knowing that it really didn't matter because the economy is much weaker than they are letting on. And of course, there's a lot of behind the scenes pressure from the Trump administration. So they're getting a cut. But what helped revive the markets over the last couple of days was FOMC members coming out, including again today, and expressing that they want to cut rates, that the Fed is now, or they are more worried about the labor market and softening in the labor market than inflation. In fact, the party line that they're all towing at the Fed seems to be that inflation is behaving, that inflation is coming down. And so what the Fed is really concerned about is potential weakness in the labor markets. And that's, of course, exactly what the stock market and other markets want to hear. And I think that is what is driving the rally. And I do expect now, I think the odds of a December rate cut, which had fallen back down from like 90% to like 50%, are now back up above 80%. So that's what's going on with the markets. And I think that is also why you're going to see this surge in gold. And I think the dollar is now just rolling over. You know, I talked also on my last podcast, or I don't know if I was on this podcast or the Schiff Gold Market Wrap, about what was going on in Japan. And that was also hurting our markets until the Fed came in with a rescue. And, you know, these statements may very well have been damage control, as FOMC members were worried about the markets and they thought they needed to, throw it a lifeline. But I mentioned yields in Japan had moved above 1.8 on the 10-year. They backed down. Now we're back above 1.8. 1.81 is what I'm looking at now. This is a new 20-year or so high as we continue to march towards, and then I believe through, 2% yields. Now, 2% yield on a 10-year may not sound like a lot, but in the land of the rising sun, it is when you're used to, or they were used to, yields of 25 to 50 basis points. So this is a huge move, and it's not going to stop at a round number. But I think that round number is going to be a significant event, because the cost in Japan to the government of financing this massive debt is going to be significant. And I mentioned, yes, it was on the Schiff Gold market wrap, that what I think may happen in Japan is that to finance the massive stimulus plan that was just announced, that they will sell treasuries to pay for it rather than increasing the issuance of JGBs, because the Bank of Japan, or the government, indicated that there would be no increase in the issuance despite this huge stimulus package that needs to be paid for. If they're smart, or I know they're smart, but if they do the right thing, they will sell U.S. treasuries, which is going to be very problematic. But of course, that's another reason why the Fed is going to have to go back to quantitative easing and easy policy to try to offset the torpedo that the Japanese will be launching our way should they decide to start selling U.S. treasuries, because they're now the number one holder. You know, they're more than Japan. China was, I think, number one, but they've stopped buying. And so we rely a lot on Japan, but that could change. So the markets are reacting to the economic data. You know, the consumer sentiment numbers came out today. We're getting more economic data, and it sank to a 7-month low. In fact, in October, the reading was 94.6, and the reading collapsed in November all the way down to 88.7. So that's a big monthly drop in consumer sentiment. And I think a lot of this is being driven by inflation, despite the fact that the president seems to believe that inflation is under control or non-existent. Everybody is talking about the affordability crisis, whether it's housing, whether it's healthcare. It's all about things are not affordable anymore. People have a hard time making ends meet. And of course they have a hard time making ends meet because of all the inflation that the government has created. I think it's very rich that both the Democrats and the Republicans agree that we have this affordability crisis. In fact, it was that issue that propelled Mandami into the mayor's office in New York City, because he was playing into the fact that everything was too expensive and that the government was going to help lower the cost of living. But of course, it's the government that raised the cost of living in the first place. And it's both Republicans and the Democrats that are directly responsible for the affordability crisis. Because the reason that things are so expensive is because both political parties have decided to fund government spending through inflation. There is no appetite at all for reducing government spending. and balancing the budget. Both parties want to continue to spend money that the government does not collect in taxes. So where does that money come from, right? It has to come from somewhere, and it's coming from the Fed, right? It's new creation, it's money creation, it's inflation. So instead of raising our taxes, in fact, they talk about cutting our taxes, but instead of raising taxes to pay for all this government, they rely on deficit spending and the Fed. And as a direct consequence of that, prices go up. On Friday, I again encouraged everybody to go out and buy Bitcoin over the weekend. I mean, not Bitcoin, to go out and buy gold and silver over the weekend, because I thought we would have a big move up on Monday. And sure enough, we had a huge move up on Monday. And so if I don't do another one, just keep on buying. Buy over the Thanksgiving holiday, buy over the weekend.
Rising expectations of deeper policy easing and a rapidly shifting leadership picture inside the Federal Reserve are adding fresh momentum to gold and silver markets, with rate cut odds rising again and the leading candidate for the next chair signaling a far more accommodative stance. Currency markets are beginning to price in a weaker dollar. That shift, combined with softening economic data and ongoing affordability pressures across the U.S. consumer base, reinforces the appeal of hard assets as protection against continued monetary dilution. At the same time, cracks spreading through the crypto equity complex are redirecting flows back toward tangible stores of value. The unwinding of speculative tech-driven instruments, the weakening narrative around digital scarcity, and the risk of benchmark index removals are collectively eroding confidence in leveraged crypto-linked business models. As capital rotates out of these unstable structures and into physical assets with real monetary history, the path for precious metals becomes increasingly defined. Now, let's get back to the interview.
Another reason that I think investors are buying gold again and why they're going to be selling the dollar is the odds shot up for Kevin Hassett to be the next Fed chair. And if you look at Polymarket, he's now in first place with a 55% chance of being Trump's pick to replace Too-Late Powell. 55%. The number two guy is at 21%, Christopher Waller, and then Kevin Walsh is down at 14%. So it's really narrowed down to those three guys, and Kevin Hassett is now the odds-on favorite to be the next Fed chairman. And of all of the candidates that Trump was considering for the job, Hassett is the most dovish. But not only is he likely the most dovish, but he's also likely to do what the president wants. He's probably the most loyal Trump supporter, being, his chief economic advisor. But I think that if Trump wants to put a puppet as Fed chairman so he can pull the strings, Kevin Hassett is the puppet that he's going to pick. So this, I think, is very negative for the dollar. It means a weaker dollar. It means higher inflation, and it means, higher gold and silver prices. And that is one of the reasons for this. So we've got the December rate cut back on track. We've got a super dove teed up to be the next Fed chairman, and the economy is weakening, right? They are, trying to figure out what to do. Trump is starting to roll back tariffs left and right, recognizing that they're not doing what he had hoped, but the economy is in trouble. He's trying to find ways to lower prices because affordability is the big problem, and he worsened that problem with his tariffs. And so now he's trying to reduce prices by removing tariffs without admitting that the tariffs are causing prices to be higher, which is obvious because if removing tariffs lowers prices, then imposing them has to raise prices. It's impossible for that not to be the case. But also, the other thing that I think is going to help the gold market is the air coming out of the Bitcoin bubble and the crypto bubble. And, no better example of what's going on there is in the stocks, these companies. And MicroStrategy, a warning, because I think it was Morgan Stanley that came out and said, there's a good chance that the indexes, the global stock market indexes, like the world MRCI index, that they're going to kick MicroStrategy stock out of the index. And that means that companies that are tied to those indexes that now own MicroStrategy or strategy. I keep using the old name. I joke they should have changed the name to Micro, because that's where the stock is going as opposed to strategy. I saw some joke online where they named the company Tragedy instead of strategy. Tragedy is probably another good name for the company. But anyway, it's strategy. But if strategy is kicked out of these indexes, that means a lot of index funds that bought it are going to sell it. Now, I 100% agree that strategy never should have been added to those index funds in the first place, because it's not a viable business. I mean, there is some kind of software business buried beneath that Bitcoin balance sheet, but it is so small, it is inconsequential to the stock. All MicroStrategy is a levered Bitcoin ETF. And why should an ETF be in an index of stocks, right? It shouldn't be. And if you are trying to buy stocks, which are operating businesses, right, that are expected to make profits by producing goods or performing services, you shouldn't be forced to buy MicroStrategy just because it's been added to an index that it never should have been a part of. And so I think it's a smart move to get rid of it. But, that will also help undercut its prestige and whatever demand there was for its shares. But, I have challenged Michael Saylor. He won't accept the challenge to debate the very premise of his business. I think the whole business model is a fraud. I think it's a sham of a company, and it eventually has to implode. Now, it may already be doing that if you look at the stock price, and you look at the stock price of all the copycat companies, the other Bitcoin Treasury companies that have gone down even more than the 70% that strategy has gone down. But strategy is not even close to finishing this bear market. But I think as the air comes out of the Bitcoin bubble, where are disgruntled Bitcoiners going to go? Well, obviously, I mean, some of them, may try to gamble, with other, tech companies, or who knows, right? There's some part of the Bitcoin trade that isn't really looking for an alternative to the dollar or looking to gold. But there certainly is a percentage of people in Bitcoin that were under the delusion that they were buying some kind of supercharged version of gold, that it was digital gold. And so they bought it. But now that its performance is so bad and the performance of actual gold is so good in comparison, I think a lot of that money is going to start moving into gold. And I think a lot of the money that maybe was on the sidelines, that wasn't buying gold or Bitcoin, but where Bitcoin was kind of killing the gold story, I think now that, the Bitcoin, fever has broke, and now the gold story, looks a lot better to a lot of fund managers who now are not going to say, well, gold, what about Bitcoin? People might buy Bitcoin instead of gold. It's going to be pretty obvious that that's not the case. The central banks want no part of Bitcoin. They're buying gold. And so investors are going to be discovering gold. I think we've already seen the lows for this pullback. We've seen the lows in silver. We've seen the lows in gold. We've seen the lows in this pullback in the mining stocks. And we are all pumped and ready to go, hitting new highs, probably even before the December FOMC meeting.
The broader shift underway in markets is now being defined by declining confidence in policy direction and a growing recognition that hard assets remain the most reliable anchor in an environment shaped by political pressure, weakening data, and fading credibility in alternative speculation. As expectations reprice around a softer Federal Reserve and a more compliant leadership structure, the dollar's trajectory continues to lean towards structural softness, reinforcing the upward bias in tangible stores of value. Momentum leaving high-risk crypto equities is also redirecting capital back toward traditional hedges as investors reassess durability, liquidity, and long-term solvency across competing asset classes. With gold and silver responding directly to these changing conditions, the next phase of the cycle is increasingly set by policy accommodation, consumer strain, and the unwinding of overextended narratives. Staying aligned with these transitions matters more than ever. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.